Following today's liquidation in the stock market, futures are down about 1.27% on the NASDAQ. S&P's down close to 1%. The Dow's down about 0.5%. And 10-year Treasury yields are plummeting to the lowest levels you have seen since the election at about 4.16%. We have some critical information to discuss here on this channel, like Delta, well, getting absolutely destroyed in after hours, following some bad news on the state of the consumer, let alone Oracle, that basically said the same thing. But first, we have to start with some quotes from Donald Trump and the White House. The White House says that the stock market plunge is not as meaningful as business activity. The Trump administration is downplaying the weeks-long stock market sell-off, chalking it up to quote-unquote animal spirits. A White House official insisted that recent moves from business leaders indicate a rosier picture of what's in store for the U.S. economy. You know, I voted for Trump, and I think these policies are what needs to happen in order to avoid a crisis 10, 15, 20 years from now, a fiscal crisis where America is bankrupt. But some of the things that they say are just not factual. Okay? Like, nothing business leaders have said or are doing is positive. Literally today, there was headlines that business leaders just want to know clarity on tariffs. Why? So they can hire people if they want to hire people. So they can invest. They can't do that without clarity. That's part of the problem. Okay, it's not just tariffs. It's the uncertainty. Because the last thing you're going to do as a CEO, which is your only job to make good decisions, is make a decision that could be a bad decision under the wrong tariff plan put forth. Or, weakening in the economy due to the uncertainty here. So, the way this is going, we will be in a recession in a couple of months. I mean, just for instance, look at Tesla, okay? This is a weekly candlestick chart. This is either the biggest leading indicator of a recession you've ever seen, or this is the biggest trade of your life, essentially. Okay, look at Tesla. Tesla has fallen almost 60% from all-time highs in about 2 months. Okay, back during like 2021 through 2023, it was actually November of 2021 through January of 2023. Tesla stock fell 75%, but it took over a year. It took 13 months. This has happened in 2 months. You are rapidly pricing in this recession. When you get a plunge like this, not just in Tesla, but Palantir, AppLovin, and other names, you don't just avoid a recession. Okay, 2022, I think we can all argue we would have had an actual recession if there wasn't so much fiscal and government stimulus. Okay, the government was spending money like they were drunk, giving out a ton of free money. Okay, whether it was stimulus packages that continued to flow, which really fueled the inflation crisis, or it was just needless spending. Okay, well, Doge is cutting a lot of that off. And even if a lot of that has not gotten cut off yet, it's not easily being distributed anymore. Okay, I actually heard about one guy that works in the railroad industry where his company was supposed to go in like halfway with the government, buy supplies, and the government had a contract with them. And well, the government canceled the contract for railroads. Who's to say that's right or wrong, right? I don't know the details of that, but it creates a lot of second tier issues in the jobs market, in the labor market, and really general confidence in the economy, which is a major problem. Now, in fact, the tariff situation is kind of reminiscent to the Great Depression. Now, I don't want to scare anyone here, okay? Because, things can get a little scary when you're talking about the Great Depression, but just a simple Google search, like this is not rocket science, will tell us that the passage of the Hawley tariff worsened the effects of the Great Depression. Technically, you were already in the Great Depression at the time, but total exports and imports dropped 67%. And most of the additional depression was from the Tariff Act, which they didn't take this off for 2 years later. By then, it was already way too late. Now, there is differences. Okay, of course, back then, the economy was mostly manufacturing. There was no tech sector. Services was a very small amount of the economy. Today, it's different. I get it. But same idea. The tariffs are really not a huge factor on the economy. It's the uncertainty from the tariffs. You're not going to go hire a bunch of people if you're a business right now because of either the tariffs themselves, or the uncertainty of what's going to happen to the economy. The last thing you want to do is heavily invest right now when the economy could be teetering on the edge of going into a recession, okay? And not having that clarity creates the issue, not necessarily tariffs. Now, Oracle today missed on earnings and issues a weak revenue guidance. Now, it's really Delta that's the bigger one to watch here. Delta Airlines cuts their guidance, citing lower U.S. consumer confidence. They say that leisure as well as business travel is down. Now, the CEO of Delta says he does not expect a recession, but we're not really in a good place. Now, I am going to share this clip with you from CNBC. This is all the indexes are likely to decline 25% before it's all done. This clip really took me back today when I heard it. And you're just going to have to listen for yourself because it's hard to argue against it. But first, a big catalyst we will get here really in the next 8-9 hours or so, it comes out at 6 o'clock in the morning, is the NFIB Business Optimism Index. This is really going to throw into question what Trump just said today about business leaders and their confidence in the state of the economy, because really after the election, this thing soared from 92.7 points in October to 101.7 points in November. It went up again to 105.1 points in December and then down to 102.8. This thing is probably going to plummet, okay, tomorrow morning. And this gives you a lot of information. Take a listen to the last month's NFIB Business Optimism Index. It says, quote, overall, small business owners remain optimistic regarding future business conditions, but uncertainty is on the rise. Yeah. Nobody's going to feel good about future business conditions. The uncertainty has dramatically increased since last month. Goes on to say, hiring challenges continue to frustrate Main Street owners as they struggle to find qualified workers to fill their many open positions. That's probably going to remain the same. Meanwhile, fewer planned capital investments as they prepare for the months ahead. So fewer last month were already planning net capital investments as they prepare for the months ahead. Basically saying, yeah, tariffs are going to make us invest less. And now you just have no idea what tariffs are going to look like. That's going to plummet as well. The net percent of owners expecting the economy to improve fell 5 points to a net 47%. So only 47% of business owners expect the economy to improve, which is actually pretty good though. That's not a terrible number, but it's probably going to plummet tomorrow morning. 18% of owners reported that inflation was their single most important problem in operating their business, down 2 points from December, and matching labor quality as the top issue. The net percent of owners raising average selling prices fell 2 points to a net 22%. 20% planned capital outlays in the next 6 months, down 7 points. You went from 27% down to 20% in a month. This thing's going to plummet again tomorrow. And unfortunately, with a plummeting like that, it's really going to reinforce some of that recession concern. Now, the NFIB Business Optimism Index, I think, is important from the market's perspective, but it doesn't really matter much to the Fed, okay? JOLTS job openings, mark my word, tomorrow, if they are really bad, will change everything. The job openings is hard data, as the Fed has said many times. They don't want to, see the stock market selling off. That's not going to change their opinion on what they're going to do with Fed policy. But hard data will. JOLTS job openings, let's say they plummet to 6 million, losing 1.7 million job openings in a month. You're probably going to get a Fed rate cut in a week and a half, 10 days or so, whenever the next Fed meeting it is. I believe it's 10 days away. That would be substantial in moving the needle for the Fed. Now, of course, if the Fed didn't cut rates then you're really opening the door for a policy mistake and then much larger downside. Okay, if all things are equal and we kind of meet expectations, then nothing changes. If this thing goes up, that's actually a good sign. That's actually a good thing for markets. Why? Because the more job openings you have, the stronger the labor market is, right? The more people looking to hire, the better the economy is. Okay, so you're expecting 7.75 million job openings. That's actually up from 7.6 million in December. What's interesting though is like the non-farm payrolls report that came out on Friday. The headline number, the non-farm number, came in at like 152,000, but the household survey came in negative 588,000. It was the second worst month since the COVID crash, right? It was really bad. But it didn't get reflected in the headline number. And now everyone basically on Wall Street expects that Doge cuts and overall weakness in the economy, more overall layoffs in the economy, are going to show up in later months. So maybe tomorrow morning's job openings report could be okay, could be strong. That maybe could fuel a bounce, short-term bounce in markets. But if it's bad tomorrow, yeah, you're going to have another terrible day. And it already looks like you're going to have a pretty rough day tomorrow, as is to begin with. Now, the next Fed meeting is 1 week, 1 day, 16 hours, 14 minutes. There's only a 4% chance of a cut. There's a 96% chance of a continued pause or nothing happening. You're really going to have to see some weak data coming out tomorrow to move that. But it could happen. Now, May 7th, you're pricing in the first Fed cut now of 2025. Is priced in at 53.6%, 44.2% chance of no cut by May, and a 2.2% chance of 2 rate cuts by May.
Welcome to you both. Bill, you say you've gone from one of the most bullish to one of the most bearish guests we have on. And so right now, is that your feeling? Watch out for the downside?
Oh, absolutely, Kelly. Look, for months I talked about the S&P going to 6,000, NASDAQ 100 going to 22,000, 22,500, the Dow going to 45,000. That seemed like a pipe dream in early 2024, mid-2024. I talked about this on CNBC on April 10th, almost a year ago. Now we've hit those targets. And so the key factor here is that the major long-term trend driving this rally, the rally off the March 2020 lows and the height of the pandemic, when it became clear that we were going to get historic monetary and fiscal stimulus, that rally is tapped out. People come on these shows all the time and say they're long-term investors. You want to stop an interview in its tracks? Ask them, what's the long term? Is it 3 years, 5 years, 10 years? Is it going back to 1929? 99 out of 100 people have no idea what to say. The long-term trend driving this move started in early 2020, in the height of the pandemic, when it became clear we were going to see historic monetary and fiscal stimulus. That is basically tapped out across the indices. I sent you the charts, the bar charts, the volume over price charts. And so that's the key factor that really got us to turn bearish. The second thing that we didn't anticipate until the last several months is the Trump administration. Every policy they have, whether it's tariffs, mass deportations, extension of the 2017 tax cuts, they all either hurt the economy, stoke inflation, or both. So you have the major long-term trend topping out, 5-year trend topping out, and you have a catastrophically incompetent administration in the White House. And the bottom line of all this is that we've only started this. We'll be lucky if we get out of this top to bottom only down 20%. I think eventually across the indices, Dow, S&P, NASDAQ 100 will end up being down 25% before it's all done.
Before I bring Victoria in to see if she agrees, disagrees, what have you, Bill, if I'm truly a long-term investor, if I have 20 years, do I care?
You care, Kelly. I mean, our clients, we advise some of the biggest hedge funds, mutual fund complexes, banks, pension funds all over the world. So for our clients, it's enormous and very important to be able to avoid this. And I think even for the average person watching the show, I think we had great years in 2023, 2024. It's not anything very esoteric. Take some money off the table. You'll be able to deploy that capital at much better levels later in the year. But right now, Trump is taking us not only into a trade war, but into a full-blown recession. And I think the mistake people are making is that we've been spoiled with these be bottoms. We go down 10 or 12% and they'll right back up. This is not going to be like that. We are going to be in for a much deeper drawdown, and I think something that's going to last a significant amount of time.
Yeah, again, that's ahead of where, most of the sort of the economists you talk to, even the bearish ones, are kind of in the camp of, okay, we only grow 1.5%. I haven't seen any recession calls yet, but to your point, it's the market's job to try to discount that ahead of time.
Now, for anyone that made it to the end of this video that is, curious on how to protect for the downside, potentially hedge portfolios, I think if shit really hits the fan, for lack of a better word, TLT is probably one of the best ways to hedge right now, right? Bond yields are going to continue to plummet. People are going to buy bonds, okay? You could see TLT anywhere in the range of 110 on the low side of a recession, like a shallow recession, as high as 140 if you actually went into something that was bad, right? That can offer you a lot of potential, gains from where the bonds are currently pricing, right? Bonds are not pricing for in recession, essentially, whereas other things are. Now, sometimes the bond market's correct and not, pricing for that recession, but it could happen quickly. Okay, it could happen slowly and then all at once you actually realize, oh crap, we're actually going into a recession. And I think you obviously would want to get time on some of these calls. Calls would be playing for bond yields to fall. And I think the risk reward makes sense. If you're trying to hedge using the indexes or using big tech stocks or tech in general, there's not really much of a trade there because they're already pricing in bad things, or they've already fallen a lot. Those premiums are stupid expensive. TLT, I do think, offers a nice way to hedge portfolios right now, just in my opinion. Again, I'm not a financial advisor, I'm not a financial planner, but some of those May, June, July $100 calls don't look too bad in my opinion. But that's, again, just my opinion. Let me know what you guys think down below in the comments section. Have a fantastic rest of your night, and I will see you in the next one.